Hong Kong is going to be a really important part of this Shanghai Gold Exchange. They're not going to abandon it, but they're going to think twice. It would mean a windfall for them without adding debt to the system. Gold is really supreme as money, not the fiat dollar. Very strong possibility that they will revalue it and have a windfall. Even I think he was being economical with the truth there. Tether, the stablecoin, they've been buying a lot of gold. People are starting to realize that this AI boom.
Mario Innecco, financial and macroeconomic analyst, as well as host of the Manneco64 YouTube channel. It is a true pleasure to host you on Palisades Gold Radio today.
It's nice to be with you, Stijn. First time for me on Palisades Gold Radio.
No, definitely. And really excited for this chat, Mario. To set the stage of my first question, gold was up close to 70% during 2025, and year to date, it is already up over 25%, and it is only the end of January, mind you. Now, to try to strip away some of the short-term noise behind that and, really focus on the fundamental long-term drivers behind that, Mario, from your perspective, what are the most important fundamental drivers behind this incredible move in precious metals and gold more specifically? And how do those fundamental drivers look today?
I think the few most important fundamentals are, first one, de-dollarization, the fact that the rest of the world outside the West and the NATO allied countries is trying to find an alternative. I'm not saying they're going to abandon the dollar completely, but they want to have the option to deal within their own system. So that's BRICS plus. And these guys know that ultimately the best reserve asset to have for a monetary system is gold and maybe even silver. And they've learned from the US that having a fiat currency as a reserve asset for a system like the US has had in the last 50 years or so is not a great idea, because it's countries are always trying to sell you everything so that they can get the dollars. But with gold is different. So that's the first fundamental reason why I think gold's going higher. The second one is the debt. The fact that the debt is becoming more and more difficult to carry. I think the world has like over $300 trillion in debt. And the bond market as well, that's going into reverse. And by that I mean the bull market we had since 1981 to 2020, that's over, and interest rates and yields are going up now. So it's becoming more and more difficult for governments to finance their debt. So what they're doing is they're using financial repression. They're trying to keep rates artificially low, as artificially low as possible. They're also tinkering with the CPI numbers so that they don't have to pay people out as much. And investors, the smart money and the bond vigilantes, they notice that, and that's why they're moving away from gold. Sorry, not from gold, but from treasuries and other fiat debt. So those are two. The third one, I guess, is geopolitical. I guess it's got to do a little bit with the first one, but the world is really turbulent and chaotic now. We don't know from one day to the other what President Trump or any other leader is going to announce. And when the world's like that, you want to have a monetary asset that is no one else's liability, or that you don't have counterparty, and gold fits the bill. So those are really, I think, the reasons why. I guess you could, a fourth one would be that the bullion banks in the West have basically run a paper market for 40, 50 years. And now with all the changes, fundamental changes that are coming, it's becoming a physical market. And that's why it's a lot harder to keep the price under control, because people will not accept paper anymore. They want physical, and that reduces the supply, artificial supply of gold in the market.
Yeah, a masterclass of putting those threads apart. And I would love to, ask a couple of follow-up questions on every single one of them. But perhaps we should start with the fourth, the paper market coming to an end. Of course, we've also seen the entrance of a new exchange, or at least becoming more popular, the Shanghai exchange, where everything is being physically traded. How much of an importance do you think that that new market is for this paper market truly coming to an end?
Yeah, I think it's very important because I think the Chinese are using the Shanghai Gold Exchange as an avenue for this new BRICS system. They are opening exchanges like in Hong Kong, vaults as well, like in Saudi Arabia. And Hong Kong is interesting because most people think, oh, Hong Kong is China, but technically it isn't. It's a Chinese, let's say, semi-autonomous region with Western rules like British common law. I think Hong Kong has more common law than England has now. So it's a way to bridge the Chinese financial system with the world's financial system without opening up the Chinese domestic system. So yeah, Hong Kong is going to be a really important part of the Shanghai Gold Exchange. Like you said, I think there is a lot of speculation in China, and the Chinese are probably bigger capitalists than we are in the West, but that exchange there is a physical exchange. COMEX, the gold contract was created back in December 31st, 1974 to be exact. That was one day before gold became legal again. And we've seen WikiLeaks documents from that time that bullion dealers in London advised the Treasury and the State Department that opening a gold futures contract for gold was going to be a good way to keep the market speculative, to keep Americans from buying physical, because they don't want that. The bankers don't want you to have physical. So, but Shanghai is completely different. It's a physical market. And that's why we're seeing, for example, in silver, I know we're talking about gold, but in silver there's a huge premium because it's the real price for physical. On COMEX and LBMA, the paper is still affecting the price, but eventually I think the price on COMEX and LBMA, that will move up towards where the physical price is. And yeah, physical trading allows the markets to discover the price. It's not a price fixing scenario like in the paper market. And one of the excuses that people give for a paper market is that it provides, the speculators and all the leverage provides liquidity. But it gets to a point where it's too much, I think. It's not really doing any favors to the mining companies that depend on a fair price to extract the metals from the ground.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Gold Corp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. Mario, silver is a very interesting topic as well, because is it fair to say that what we're seeing there with that bifurcation between Shanghai and the West, New York, and the Commodity Exchange in New York, this almost $10 split per ounce on silver currently, that this is an exaggerated form of what we're also potentially seeing on gold?
Yeah, I mean, I don't think there is much of a premium right now on gold, but I think last year at one point there was. But the gold situation is a little different because gold is mostly a monetary metal, and people do want physical gold, but in the case of silver, a lot of industrial producers of everything, they need the physical. So, and the stock to flow ratio of silver isn't as big as gold. So you probably know that with silver, there's been a deficit for the last 5-6 years. With gold, there isn't so much of a problem, but it's possible to happen as well between the West and the East, the arbitrage opportunity. I think during COVID, there was quite a big discrepancy.
No, definitely. And I believe your first reason that you named for gold first fundamental driver was de-dollarization. Of course, gold surpassing US dollar treasuries for central bank holdings surpassed it last year. It made waves in our sector. I'm sure you've seen it as well. It hasn't really surpassed the US dollar as a holding for central banks just yet, but US treasuries, it has surpassed. How much further do you think this de-dollarization trend could go, and is central bank buying really being a tailwind for this bull market in precious metals?
Yeah, I think it's still got a ways to go. Historically, if you go back, let's say to the 19th century, Britain used to keep one third gold cover, i.e., there was for every pound sterling there was a third of a pound in gold. Yeah, the Fed used to keep 80% gold and then 40%. So I think that's where the central banks are looking for, at least a 40% holding relative to their paper assets. They'll have physical gold, and it could be more. So that's why I don't think it's finished. And especially with what's happening geopolitically now that the world's splitting apart from unipolar world to a multipolar world, and with President Trump changing his mind every day about things and driving up uncertainty, I think countries want to have want to be less reliable on the dollar. They're not going to abandon it, but they're going to think twice, and they're trying to find new markets and new trading partners where they could trade with their own currencies, but those currencies would have a neutral reserve asset like gold or even silver. The higher the price of silver goes, the more interesting silver becomes as a reserve asset for central banks. I remember back in the beginning of this century when I started buying some silver. Silver was like $5-6. It wasn't worth for central banks to keep bulky silver as a reserve, but at 120, where we are now approximately, or even 200 or 500, it's a different story.
Yeah, and I believe there's also historical precedent for central banks in the past holding silver as a reserve asset, didn't they?
I mean, I'm not too read up on that, but I wouldn't be surprised. We had a bimetallic system in the US until the 1870s, even though the Second Bank of the United States was abolished in 1836. So they didn't have a central bank at the time. But yeah, I think the Germans, they're the ones who triggered they call it the crime of 1873. They won the Franco-Prussian War in 1870 or 71, and they had a lot of gold, a lot of silver, the Germans, and that was probably on their reserves. But one of the bankers convinced them to sell the silver from their reserves, and that's what. So yeah, it has been before. And Stijn, if you look at the name for coins and the name for money in many languages, it means silver.
Yeah, that's a really interesting point on the psychology of that, of course. You know, you mentioned earlier on that global debt is around $300 trillion right now. I believe global government debt is around 110, $115 trillion as we speak currently. And it seems to be growing faster than GDP is. That kind of seems like we're at the cusp of an inflation spiral, doesn't it?
Yeah, it is. And the thing is, our governments, especially in the West and in Europe, they're not thinking about shrinking the size of government and shrinking regulation. Even in the US, you could argue that Trump is more pro-business, but government is also getting involved in the economy there. They had that big, beautiful bill. They hope that they will trigger more growth, but I'm not too convinced. So yeah, the thing is that we've become so dependent on government spending that if they were to do the right thing and cut back on fiscal spending and borrowing and let the economy, the private sector thrive, cut taxes, that would probably create a short-term event that would trigger a major recession, and politicians hate that. So yeah, they're going to keep inflating, and the debt's going to keep growing. And if we can't get GDP to grow faster, and I think it's going to be difficult because government is crowding out the private sector, then they're going to have to start printing to pay the interest on the debt, to pay off debt that's coming up for renewal. And that's what leads to hyperinflation. That's what the Germans resorted to back in the 1920s. And it's a very dangerous environment. And the problem is, the longer you leave it, the more probable that it is that it will happen.
Yeah, definitely. A few months ago, I had Doomberg on the show, who in a different context mentioned that the US is sitting on an incredibly vast resource of hydrocarbons, both in natural gas and oil. Of course, one could make the case that energy, hydrocarbons, is GDP, or at least very closely correlated with GDP. If we had a government that managed the country efficiently and you really try to optimize everything for growth, could there be a case in which you think the United States or even other Western countries might be able to outgrow their debt faster in GDP growth than their debt is growing?
Well, I mean, I've heard the same thing, that there's loads of oil reserves in Alaska, but why don't they allow, I don't think it's a country's, the government should be involved in doing, they should allow the private sector to do it. But my question is, if the US has got so much hydrocarbon wealth, how come they're having to go after Venezuela and Iran, right? Something doesn't, something doesn't really match there. But I agree. I mean, look at Russia. They've got a lot of resources. They've got loads of hydrocarbons and oil. Yeah, I mean, Norway has a lot of energy and stuff, but it doesn't mean to say that a country that has all these natural resources doesn't mean to say they're going to manage things well and that they're going to become wealthy. I think it's called the Dutch disease, right? And there's something to that effect that, look at Switzerland. Switzerland doesn't have much natural resources, but it's a very wealthy country. So I think the problem with the United States and other Western countries is profligacy. It's that governments and also the public they're entitled. They want everything for nothing. And there is no such thing as a free lunch, Stijn. Ultimately, we're going to pay for things. And unfortunately, that's why we are in the position that we are with all the debt. And you can have as much hydrocarbons or whatever, but if you keep doing the same thing, like spending and borrowing and like crazy and living beyond your means, it doesn't really matter.
No, it doesn't really matter. Mario, do you believe a gold remonetization or a revaluation might be in the cards for the future? I mean, if you look at the incentives for governments, not necessarily politicians, but governments, if they were to do that, the balance sheet would look pristine all of a sudden.
That's right. I mean, just think of it in your own situation. For example, if you bought gold 20 years ago at $400 and now it's at 5,000, you're going to value it at the market price, and you might want to sell some to pay off some debt or to invest in something. So it's the same thing for governments. The US, they've had the price of gold, the US Treasury, set at $42.22 since 1973. It's called the statutory price. And they issued gold certificates for the Federal Reserve. They hold that, and it's worth 11 billion. Yeah, and there's been a lot of speculation since last year about them maybe revaluing it. It would mean a windfall for them without adding debt to the system. Yeah, and I think the reason they haven't done it before is because by doing that, revaluing it, they admit that gold is really supreme as money, not the fiat dollar. So they'll try to hold off doing that as much as possible. But now with all the debt and this affordability crisis, which I think is more just currency debasement, right? President Trump is desperate to please the bottom 50% who haven't really benefited from all the inflation and the inflation of financial assets before the election. So I think it's a very strong possibility that they will revalue it and have a windfall. Even if they revalued it to just above 4,000, they'd have an extra $1 trillion to play with. If they revise it to 5, a little more, and so on. And they could always do layered. They could revalue it this year and then in 2 years and keep doing that. So yeah, it's possible. And I spoke about it recently, and we've been covering it on the channel for a while. And even a guy called Colin, I think, Weiss or Barry, I think it's Colin, from the Fed, he wrote something about that for the Federal Reserve Board back in August last year about revaluation. So it is something they're thinking about, even though I think yesterday Jay Powell at the press conference, when asked about gold, he basically said, I don't care about gold, I don't follow it. But I think he was being economical with the truth there.
Economical with the truth. Mario, middle to beginning of last year, 2025, there was a lot of speculation of gold flows flowing into the United States. There was a mystery buyer on the commodity exchange that only seemed to be willing to buy at the COMEX, no other exchange. Do you have any speculation as to what might have happened there? And on the gold flow side, what are we seeing currently? Is there anything to glean or learn from gold flows currently?
Yeah, I mean, one big thing that's happening is with Tether, the stablecoin. They've been buying a lot of gold, and they've been buying also shares in gold royalty companies. And if you look at Tether, there's two companies. There's Tether, I'm not sure where it's based, could be the Bahamas, but it's an offshore company. But there's a Tether USA. And I spoke to Andy Schectman on my channel of Miles Franklin last year, and he thinks that Tether USA might be a front for the U.S. Treasury, so that the U.S. Treasury might be buying the physical gold. As for last year, a lot of the physical gold that was going to the U.S. via COMEX, it could have been the Treasury. If they revalue the gold, you know, there's been speculation over the decades that a lot of that Fort Knox gold has been leased out and it's not there anymore. So if you're going to revalue gold, you need to show the public and the market that the gold is there. You can't just, you know, say, oh, trust us, we've got the gold. You need to do an audit. So when you lease out the gold flows out. And if you want to get the gold back, you have to buy it back. So it could be the government, or it could have been because of tariffs. A lot of the big investors thought, it was going to get harder to get physical over from the rest of the world with the tariff regime. That wasn't really the case because there's no tariff on monetary metals for now. But the other thing as well is, as I said earlier, the world is becoming more and more deglobalized, and I think the era of where you trust you trust people to keep your gold in London while you're in LA or whatever, that's ending, and people want to have the gold close to them or in their possession, because that's the whole advantage of gold, is that it's no one else's counterpart. It's not there's no counterparty risk. So yeah, it could have been. It's difficult to say who it was, but I don't think it was mom and pop, retail investors, because the COMEX makes it really hard for small investors to take delivery. So there were big money people or even government.
Yeah, no, definitely doesn't seem like it was a mom and pop situation. You spoke earlier that you think a revaluation of gold there's a very strong possibility for that, I believe was your words. Oftentimes this idea of a BRICS settlement currency is floated, which could potentially be 40% backed by gold, 60% backed by the fiat currencies behind, the BRICS. Do you think a partial remonetization through a BRICS settlement currency could potentially force the US or the West in general to look at that as well and potentially also remonetize?
Definitely, because from all the studies I've done over the years, and I don't remember exactly who said it, but the thing is, and it's one of the reasons why the U.S. has been so aggressive about defending the fiat dollar, is that if you allow a country that's strong enough to create a gold-backed system, it's a huge threat to the dollar, because what would you rather have, a system where it's backed by sound money, or a system that's based on unbacked debt? So we've seen in the past, Stijn, people like Saddam Hussein, the guy from Libya, Gaddafi, who tried to create their own currencies, or at least trade not with the dollar. We've seen what's happened to them. But when you have Russia, China, India, and like a lot of the Middle Eastern countries getting together and cooperating, it's much harder for the US and the West, for that matter, to basically neutralize this effort. So yeah, it's possible that they will have to join and remonetize as well. We've seen that recently. Poland announced their central bank, they're going to increase their holdings from 550 tons to 700. So, and Poland is kind of, I guess, more in the West. So I know it has a past of being in the Soviet sphere of influence, but yeah, I wouldn't put it past the West having to do the same.
Well understood, Mario. I'm trying to get a gauge for how far this bull market could potentially go, and I think a lot of people are thinking along those lines as well. When we look at historical parallels, are there any that you think are fair to compare our current situation to? And is there anything we can learn from those historical parallels? History, of course, does repeat itself, but sometimes it rhymes.
Yeah, I guess we are in the fiat regime, right? Prior to 1971, it's difficult to find any parallels. So if you look from 1971 till now, the bull market in 1971 went from 35 to almost 200 by the end of 74. And then gold corrected back down to just above 100, I think in 75, 76, 77. And from there, it went from, let's say, just over 100 to 887.50. That was the high in 1980. So it went up eightfold in that leg. And then when you look back at 2001, we bottomed in 99, 2001. Some people have a different, they say it's 99. Some people say 01, but it bottomed around 250. And if you do 8 times, you get like around 1900, right? That was the high in 2011. And then from 2011, we saw a bottom in late 2015 at 1,045. So if you take those two bull markets we've had since 71, where you had an eightfold increase, and you do 1,045 times 8, you get around 8,300. So that could be an obvious target, but one could argue that the system is so much more leveraged these days with all the debt, all the derivatives. We didn't have like quadrillions in derivatives back in the 70s. I guess we did have a lot of derivatives in 2011, but now it's so much more that we could argue that, 8 could be conservative, but I think it's definitely possible. The other indicator people look at is the Dow gold ratio. Also, you look back at history, back in 1932 or 3, it bottomed at 2 to 1. 1980, it bottomed at 1 to 1. So, and every time it bottoms, it's when the credit market is flushed out and everything starts again. So that could be also like a target for the where the gold and silver bull market will end, when the rebalancing between the stock market and hard assets occurs. And I think that's what the Dow gold ratio represents. So maybe 1 to 1, it could even be less. You could only need half an ounce of gold for 1 Dow. At what price that will happen, it's difficult to say, but I think that will be a good mark of like where you could say that now it's over the bull market. And it's not even, and if gold and silver become part of the monetary system, we might not have the corrections we had in 1980 or 2011, because it will stay fixed wherever it ends up.
Yeah, I think that opens up a very interesting follow-up question. Oftentimes we hear this term, the debasement trade, and a trade, of course, implies getting out. And you're already kind of talking about this topic as well. If we are potentially entering a completely different financial system than the one that we just came out of, should one even think of exiting, or should one stay in hard assets, monetary assets like gold and silver?
Well, I guess that's the similar question to how much money should you save or have in the bank, so that, because that's what gold and silver will become. You will exchange it for other assets or goods and services, but you won't care really that there won't be a price for gold and silver. Gold and silver will be money. So but I think they will have a much bigger purchasing power than they have now, versus a lot of stuff. And it's already happening. Back in 2000, you needed 40 odd ounces of gold to buy 1 Dow. Now it's below 10.
No, definitely. Hey, Mario, we talked about silver a bit earlier on. Of course, silver is up, I believe, over 50% year to date. And again, it's only the 29th of January currently. So incredible returns that we're seeing over there. From your perspective, could you outline what you think is happening over there and why is it happening to silver now?
Well, I think silver is following gold. And gold broke out really in beginning of 2024 through that 2000, 2100 level. And it's taken off since then. There's been some corrections along the way, but silver had been still even below 30 up until recently. And then finally went through there last year and then tested 50. And 50, of course, has been like a ceiling since 1980. And now that it's gone through there, yeah, it's really taken off. And historically as well, since the 70s, silver has always come to catch up with gold and outperform gold towards the, let's say, the second half of a bull market. So I expect silver to continue to do well and to outperform gold going forward. I mean, historically, the gold-silver ratio in the last few hundred years or even thousands of years has been more in the teens than, 100. We got above 100, the gold-silver ratio. Now it's around 50. It's a lot lower than we were in the last few years, but it's still right in the middle of a range, I would say, of the historical norm.
Thank you, Mario, for that outline. I have a question from the Aussie Silver Stacker. If I could ask you, what do you think will happen to silver if the USA would revalue gold to a significantly higher level?
Yeah, well, I think silver would follow. Yeah, would follow gold higher. Every commodity would follow gold, I think, if they revalue. That's what happened, I mean, in the 70s. The last time the US revalued gold was in 1973, and look what happened to silver in that decade.
Yeah, no, definitely. Hey, Mario, we were talking about the bifurcation that we're currently seeing between the West and Shanghai. It's a significant premium that we're seeing for the physical markets. And of course, the commodity exchange, the COMEX in New York, they have a lot of history with trying to suppress squeezes on physical. I mean, the Hunt brothers is an example for that. What tools do they still have up their sleeve to potentially suppress the price of silver?
They're running out of ammo, I think, because a lot of the players in these markets, they're moving to East, to trade in the East. The rules say that they can impose force majeure on the markets and settle everything in cash. But, they've recently changed the margin regime from one where you pay a fixed amount for the contract, for one contract, to where you pay a percentage of the value of the contract. So that changes daily, and it doesn't seem to be working. So I think they're in trouble, the COMEX and the LBMA, and the only way to fix things is for price to go a lot higher, and for them to, the participants in those markets, to attract people who want to sell physical, so they can replenish their vaults, because right now they're dwindling, and even in China the vaults are also dwindling, which is interesting.
That is definitely interesting. I have a follow-up question from the people over on X. Baitcunt is asking if there's a exact mechanism that a customer could use to demand physical silver, in a case where force majeure could be called for and they're forcing cash settlement, if there's anything a customer could do to demand physical.
Not really. I mean, I remember back in 2021, in the first silver squeeze movement, Rafi Farber and a few other people, they tried to take one contracted silver 5,000 ounce bar, and they gave up. So the exchange won't care if a retail investor wants his physical, especially if they impose force majeure and cash settlement, because it's within the rules. They can do it.
Yeah. Mario, what are you thinking of the commodity complex as a whole? It is still a very small, if not minute part of the entire equity complex, if not just the entire asset complex that we're seeing out there. So is there a potential for continued, capital rotation into the commodity complex?
I definitely think so. I mean, I've been early on this as far back as 2019, 2020. I could see that the bond market was going to turn from a bull market to a bear market. And I said then that, investors would start favoring hard assets more. But it's a slow process. I guess we had a big move in commodities from 2020 to 2022, and now it's kind of gone sideways. But on a relative basis, commodities have been really ignored on the whole by investors, and I think also people are starting to realize that this AI boom and tech boom, data boom, these things, the infrastructure for these things, these technological advances, they need a lot of raw materials as well. So yeah, I definitely think it's a good place to be relative to like stocks and bonds.
What do you think of platinum and platinum group elements currently? Are we seeing a similar fundamental, as we discussed for gold and silver, driving it, or is it a different asset class altogether?
Yeah, I mean, it is a hard asset and like a commodity, so I expect them to keep doing well. But it's different because it's not really a monetary metal. So yeah, that's how I look at that.
And what do you think of the gold and silver miners? Of course, oftentimes we hear that they could provide leverage towards a move in gold and silver, but they can also provide a value proposition in and by themselves as their literal cash machines. They produce gold and silver, which you could argue is a form of cash. Isn't it an interesting place to look for value opportunities currently?
Yeah, I mean, if you look at the silver ETFs like SIL, SILJ, like the silver miners, they're heavily undervalued versus silver. Even the gold miners are still undervalued versus gold, and especially versus like the overall stock market. And of course, you have to do your homework on those. There's all different kind of miners. There's the big producing mining companies, which are safer, but I guess they won't move up as much as the smaller. And also the more speculative are, of course, the junior exploration companies who are just drilling to try to prove that they have resources and hoping that they'll be taken over. So, and then you have all the other risks like managerial risk, the people running the companies, and you have the political risk and the country risk. So I think one way to think of it is if you have $100, and I guess that depends on each individual, but I would say a good rule of thumb, you have $100, you put 90 into physical gold and silver and 1 into the, 10 into the miners. And if the miners do really well, that 10% will catch up with the 90 cents. But let's say the miners go down 50%. Yes, it's a 5% loss overall, which isn't nice, but it's not going to destroy you financially. So that's how I would look at it.
Yeah. Mario Innecco, thank you so much for your time and your insights today. Is there anywhere that you would like to direct the viewers? Of course, we'll put your channel in the description.
Yeah, at Manneco64 on YouTube. And that's where I am.
Yeah, awesome. Mario, it was great picking your brain. Thank you so much for your time and your insights today. Really, really appreciate it.
You're welcome. And it was nice speaking with you, Stijn.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.